A hypothetical scenario. The U.S. president uses the 1934 Gold Reserve Act to revalue the gold price to $20,000 per ounce. This is not just an accounting adjustment. It is a shock wave that shakes the foundation of global financial architecture. The mechanism is simple but devastating. The U.S.'s 261.5 million ounce gold reserve is currently recorded in official ledgers at $42.22 per ounce. This is a pricing left over from the 1930s. If this valuation is raised to $20,000 with a single stroke, the Treasury instantly creates accounting credits at the Federal Reserve. The gold certificate mechanism kicks in. The Treasury cuts certificates from the new valuation. The Fed, in return, loads trillions of new dollars into the Treasury's account. The target is the $38 trillion national debt. For decades, this figure has been labeled unsustainable. But with a single administrative decision, the government attempts to lighten the debt burden by repricing the only tangible asset in its hands. The reality of mathematics. As of December 2025, U.S. national debt exceeded $38.4 trillion. Total gold reserves at Fort Knox, West Point, and Denver are 261,498,926 troy ounces. At a $20,000 revaluation, the total value of this gold reaches approximately $5.23 trillion. An impressive figure, but reality chills. This amount covers only 13% of total debt. To completely erase $38 trillion of liabilities, the gold price would need to be revalued to $146,845 per ounce. The mathematics is clear. $20,000 is not a debt solution. It is a liquidity injection. The remaining $33 trillion of debt remains as a hyperinflationary anchor. The dollars in your pocket are not saved by gold. They are exposed as hollow shells. Global acceptance or rejection? The critical question, will the rest of the world accept this revaluation? According to December 2025 data, China officially has gold reserves exceeding 2,350 tons. However, insider information indicates the real figure, including hidden military stockpiles, could exceed 15,000 tons. Poland reached 531 tons. Turkey holds 641 tons. For these countries, $20,000 gold is a double-edged sword. If they accept the price, central bank balance sheets explode 400 or 500% on paper. This is an incentive almost too large to refuse. But note that acceptance doesn't mean they will continue to accept the dollar. The likely outcome is fragmented acceptance. The world recognizes gold's value, but instantly pivots to a new neutral settlement system, perhaps a BRICS-oriented commodity basket. The dollar becomes an isolated island currency. The rejection scenario is chaos. If other countries reject the revaluation and continue trading at the roughly $4,300 market price, trade flow turns into a weapon. If a German manufacturer refuses to accept your revalued dollars for a medical equipment shipment, and the U.S. refuses to send physical gold to bridge the gap, the mechanism of global trade freezes. Complete collapse of international order, a transition where trust is replaced by a cold, transactional barter system. The birth of supercreditors. A silent transformation occurred in the vaults of world leaders. As of late 2025, China declared reserves exceeding 2,300 tons, India 880 tons. India nearly tripled its holdings in 2 decades. Europe's giants, Germany 3,350 tons, Italy 2,452 tons, France 2,437 tons. They refuse to sell a single bar for decades. They know that gold is the only asset that doesn't require a counterparty's promise to pay. When the price reaches $20,000, the balance of power on this planet shifts instantly. Poland, which aggressively added over 500 tons, suddenly finds its national currency backed by a massive revalued shield. Turkey, with 641 tons, holds a hammer against its foreign debt. Emerging markets transform overnight into the masters of the reset. New supercreditors are born. While the U.S. struggles to cover a portion of its $38 trillion debt, these countries suddenly possess hard surplus that allows them to dictate the terms of global trade. Why would a leader in Beijing or New Delhi continue to trade tangible goods, electronics, steel, grain for paper dollars that can be revalued at whim? They won't. They demand settlement in gold. The era of the dollar's exorbitant privilege ends here. Gold-hoarding nations use their new wealth to build a parallel financial system where rules are written in grams and ounces, not in the printing offices of a central bank. Trade deficit collapse. For more than half a century, the U.S. enjoyed what economists call exorbitant privilege. In late 2025, the trade deficit is at approximately $52.8 billion per month. This means receiving billions in tangible goods. Cars from Germany, electronics from China, textiles from India. In return, nothing is sent but digital entries and paper promises. Inflation is exported to the rest of the world. The world's labor is effectively obtained for free. Under the $20,000 gold peg, this magic trick hits reality's brick wall. The free ride ends. If other countries accept this new valuation, they won't accept a devalued, fluctuating dollar as payment for their physical resources. Why would a nation like Saudi Arabia or the UAE trade a barrel of oil for 100 paper dollars when they can demand a specific microscopic weight of gold? Trade shifts from credit-based to physical settlement. The barter and bullion era begins. The U.S. trade deficit doesn't just shrink, it's forced into violent immediate balance. If iPhones from China or grain from South America are wanted, payment is required in something they value, either gold or goods of equal worth. Gresham's law applies to international commerce. Bad money, the unbacked dollar, is driven out of the global trade loop. Good money, gold-backed value, becomes the only language the world speaks. For the average citizen, this means the end of cheap imported goods. The $1,200 smartphone is the product of a world where the dollar was king. In the world of $20,000 gold, the cost of importing the same phone could triple, not because the phone changed, but because the paper used to buy it has been stripped of its illusions. A global economy is approaching where you only get what you can actually afford to pay for in real physical terms. Scenario A, the hyperinflationary end. If the rest of the world rejects the new $20,000 gold peg, a financial tsunami, the likes of which history has never seen, is encountered. Over 30 trillion euros of U.S. currency are held in foreign banks, circulating outside borders. For decades, these dollars functioned as a common language for global trade. The moment the U.S. unilaterally reprices its gold, this utility vanishes. Foreign central banks and private investors, fearing their dollar holdings are being liquidated by stealth default, begin to dump U.S. treasuries and paper currency simultaneously. The fundamental law of supply and demand kicks in. When that $30 trillion offshore hoard comes home to the U.S., the money supply circulating within borders explodes. The actual volume of goods, services, and food produced in America cannot increase overnight to match this sudden cash flood. The only thing that can happen is a massive vertical spike in prices. The mathematical certainty of hyperinflation, every dollar once used to buy oil in Riyadh or electronics in Shenzhen suddenly returns to the domestic economy competing for the same liter of milk or liter of petrol in your local neighborhood. This dollar repatriation leads to terminal collapse in purchasing power. Not controlled 2% inflation, a kinetic event, a currency firestorm. As the world dumps dollars, the exchange rate against the euro, yuan, and yen falls off a cliff. Every imported component for cars and computers becomes prohibitively expensive. The U.S. becomes an economic island choked by its own repatriated paper. Life savings held in dollars are reduced to the value of the paper they're printed on, while those who anticipated the reset watch from the safety of their physical gold. Scenario B, Bretton Woods. 2.0. The alternative, the world actually accepts the $20,000 gold peg. This would be the birth of Bretton Woods 2.0, a fundamental reimagining of global financial architecture. The era of floating exchange rates and funny money ends with a screeching halt. If China, India, and European powers agree to this new standard, the price isn't just being adjusted. A global straitjacket is being installed on sovereign debt. Under a true gold standard, governments lose the ability to print their way out of a crisis. Fiscal policy suddenly becomes a matter of cold, hard mathematics rather than political whim. If a nation wants to spend, it must first produce or tax. It can no longer borrow from a future that never arrives. For gold-hoarding nations, acceptance is a victory lap. As central bank balance sheets' gold reserves are revalued to $20,000, they are instantly cleansed of paper risk. National currencies become the most stable and attractive in the world. As the world's capital flees from debt-heavy Western banks toward the hard vaults of Warsaw, Ankara, and Shanghai, massive rotation is seen in high-net-worth wealth management. These countries are no longer emerging. They become the anchors of global stability. But for the average citizen, this stability comes at a heavy price, the end of growth as we know it. In a world where the money supply is pegged to metal extraction from the earth, the economy can no longer be stimulated into existence. A period of prolonged grinding deflation is entered. While a 100-pound note can buy more next year than it does today, the cost of servicing a mortgage or business loan becomes a crushing burden. As the value of debt stays fixed while the money supply shrinks, trade becomes a zero-sum game. The trade deficit vanishes because the U.S. can no longer pay for Chinese imports with promises. It must pay with the very metal it just revalued. A world of absolute fiscal discipline where gold's ultimate rule determines who prospers and who perishes. Modern confiscation risk. To make a $20,000 gold price stick without bankrupting the treasury, the government must control supply. This brings us to the terrifying possibility of a modern Executive Order 6602. In 1933, President Roosevelt used the Emergency Banking Act and the Trading with the Enemy Act to declare a national emergency. He effectively criminalized the private ownership of monetary gold. Citizens were given a choice: surrender your gold for $20.67 per ounce or face 10 years in federal prison and a $10,000 fine. Months after the gold was safely in the hands of the Federal Reserve, the government revalued it to $35 overnight. The American people were stripped of 41% of their wealth's purchasing power. Today, the legal framework for a repeat performance remains dormant but dangerous. Private ownership was restored in 1974, but the president still wields broad emergency powers during a systemic liquidity event. They cannot allow you to profit from the revaluation they created to save themselves. The official price is $20,000, but if you bought your gold at $2,600, you hold a 700% profit that the government desperately needs to fill its own $38 trillion hole. Modern confiscation won't just be about door-to-door seizures, it will be about digital compliance and forced buybacks. Industrial and energy. Shock. Revaluation to $20,000 is not just a change on a screen, it's a 500% tax on the future of technology. An average high-end smartphone contains roughly 0.03 grams of gold. The cost of just the raw metal jumps from a few dollars to nearly 20. Across billions of units and complex devices like surgical robots or server farms, the compound effect is a completely different story. In the automotive sector, electronics account for approximately 30% of a car's total manufacturing cost. Gold is the primary material in engine control units, ECUs, and critical sensors for automatic braking and fuel management. At $20,000, a standard vehicle's price rises by thousands of dollars just to cover the increased cost of reliable connections. The green transition hits a brick wall. High-efficiency solar panels and electric vehicle charging systems depend on gold's unrivaled conductivity and corrosion resistance. By making the precious metal too expensive to use, the government effectively bankrupts the solar and electric vehicle industries. It stalls the shift toward renewables and forces a return to simpler, less efficient machinery. A split is seen in the market. High-end technology becomes the exclusive domain of the elite. As the U.S. is pushed back toward a low-tech existence, companies are forced to substitute gold with cheaper, less reliable materials like copper or silver. This leads to a massive spike in device failures and shorter lifespans in everything from laptops to life-saving medical pacemakers. The price of energy is the floor under every other price in the world. If we return to a gold-settled world where gold is $20,000, the petrodollar system that has allowed the U.S. to trade paper for oil since 1974 draws its last breath. OPEC, plus oil-producing nations, observe the new American mathematics. They won't continue to sell their black gold for devalued paper. They demand payment in gold grams. If the historical ratio where a barrel of oil costs roughly a gram of gold is applied, a $20,000 gold price means a staggering $640 per barrel of oil. This is the energy shockwave that collapses the global logistics chain. At $640 per barrel, the cost of diesel, the lifeblood of modern farming, becomes an insurmountable wall for the independent farmer. Fertilizer, largely derived from natural gas, sees a similar vertical spike in price. The U.S. sees the return of 19th century economics in the 21st century. Farming moves back from high-tech industrialized precision toward localized manual labor. The cost of running a tractor or shipping a ton of wheat across the country becomes higher than the value of the crop itself. The end of the global food supply chain as we know it. Grocery store shelves, currently taken for granted, become a battlefield of price discovery. In the world of $20,000 gold, the invisible rule of energy scarcity dictates that food becomes a luxury. Every calorie consumed is essentially a unit of energy. If this energy is priced in revalued gold, the cost of bread, meat, and vegetables must follow the same trajectory. The global economy built on the back of cheap energy and cheap dollars finds itself paralyzed, unable to move goods from where they are grown to where they are needed. Resistance and shadow economy. The psychological shift between 1933 and 2025 must be understood. When Roosevelt issued Executive Order 6602, trust in government was at an all-time high. Even then, while an estimated 500 tons were surrendered, millions of ounces simply vanished into floorboards and family heirlooms. Today, that thin veil of trust has evaporated. We live in an era of decentralization, where the boating accident has become a cultural metaphor for refusing to let the state reach into private lives. If a modern confiscation is announced, the government won't face a compliant public. It will face a sophisticated, silent insurgency. Data shows that private gold holdings in the US are now more dispersed than at any point in history. Attempting to enforce a forced buyback on millions of private safes is a logistical impossibility. Instead of civil war, the birth of the ultimate shadow economy is seen. Gold becomes America's ghost currency. In a world where the dollar is revalued at 20,000, a single gold sovereign, or 1 ounce Krugerrand, becomes a liquid asset that can buy a year's worth of fuel or a tractor load of grain on the black market. The government can declare your gold contraband, but in doing so, it only solidifies its status as the only thing with true untraceable value. For the average citizen, the choice between obeying a law that strips 85% of your wealth or becoming a monetary outlaw is no choice at all. A split society is seen, those who surrendered their futures for a paper receipt and those who moved into the shadows, waiting for the storm to pass. This isn't just about metal, it's about the ultimate breakdown of the social contract between the ruler and the ruled. Conclusion. A world where gold is revalued to $20,000 has been examined. A world where $38 trillion of debt is partially cauterized, where nations like Turkey, Poland, and China rise as the new titans of trade, and where the industrial foundations of tech-driven lives begin to crumble. This is not a distant theory. It's the mathematical outcome of a system that has reached its physical limits. It's vital to state clearly, this analysis is for educational and historical purposes only and is absolutely not financial advice. Every decision made must be based on your own research in this rapidly shifting landscape. The invisible rule of history: when a currency reaches the end of its life cycle, the transition to the new system is not televised until it's already complete. They tell you the dollar is as strong as ever, even as they move their own wealth into the very assets they tell you not to buy. In this new global order, the question isn't just whether other countries will accept a $20,000 gold price, it's also whether you can accept the reality of a world without cheap credit. We are standing at the edge of a new Bretton Woods, a hard money reality that will separate those who saw the signal from those who only heard the noise. The mathematics is undeniable. The laws are on the books, and gold is moving in silence. You have seen the data, you have heard the rules. Now you must decide where you stand in this $38 trillion gamble. At Falling Value, we continue to analyze monetary system, structural transformations, central bank strategies, and gold market dynamics. We bring you geopolitical risks that financial media ignores but will affect your portfolio. Don't forget to subscribe and turn on notifications.